In this video, we're going to prepare a flexible budget and a variance analysis report. Our variance analysis report will compare an original budgeted amounts with actual performance results, calculate variances, and break those variances down into basically spending variances and sales activity variances. Our first step is to prepare our flexible budget. Let's begin by writing down and preparing cost formulas for each of the items on our master budget. Our cost formula, or really I guess it's a revenue formula for our revenues, is y equals 0 plus 10x. There's no fixed component, and our variable cost or variable sales price is $10 per unit. We can get that by taking our budgeted revenues of $1 million and dividing it by our budgeted level of sales. The cost formula then for variable manufacturing overhead will be 0 for the fixed component because these are variable costs, and we take our $380,000 in budgeted cost divided by the 100,000 budgeted units and get $3.80 per unit. The cost formula for variable selling cost is 90 cents per unit. Our cost formula for fixed cost, simply y equals 200,000 plus 0x. Again, there's no variable component. For fixed selling, it's y equals 140,000 plus 0x. And then we're given information regarding our standard costs, and we can come up with cost formulas per unit for our standard cost. For direct materials, it's $2.20 per unit. For direct labor, it's $1 per unit. And for variable overhead, it's 60 cents per unit. And again, those are simply the standard quantity of 4 pounds or units per item times 55 cents. Direct labor, 0.05 hours times $20 per hour. Variable overhead, we're applying on the basis of labor hours as well, and it's 0.05 times a predetermined overhead rate of $12 per hour. We're also given information on the actual quantity of materials we purchased, the actual number of direct labor hours worked, as well as the rates or costs for each of those. These will be important when we break down our variances further later on. So our first step in preparing our sales variance analysis report, recall, is to prepare our flexible budget. And our flexible budget recasts our original budget, which was based on 100,000 units, based on an actual level of activity of 80,000 units. In other words, what would we have expected to spend had we known originally that we would have only had 80,000 units in sales? We calculated above our cost equations for each. Our selling price, recall, was $10 per unit, so 10 times 80 gives us 800,000. Our direct material cost was $2.20 per unit, so we get $176,000 for budgeted direct material cost. Our budgeted direct labor cost would be $80,000 or $1 per unit. The variable manufacturing overhead would have been $48,000. Variable selling, $72,000, for a total contribution margin of $424,000. That's our $800,000 in sales revenue minus our variable cost. Our budgeted fixed cost, again, fixed costs don't change with the level of activity. We would have budgeted $200,000 for fixed manufacturing overhead and $140,000 for our fixed selling cost, giving us a total bottom line net income of $84,000. Let's go ahead now and take a look at our sales activity variances. We had a variance of 20,000 units, and in Chapter 17 we'll break down this 20,000 sales activity variance into both a volume and market share variances. The volume variance will evaluate how much of our change in sales, in other words, how much of that $20,000 is due to an overall change in the level or size of the entire market or industry, while the market share variance will help us analyze what happened to our overall share of that market. So the volume variance Did the sales of this particular item increase or decrease overall? For instance, the DVD market, it is shrinking over time, and we would expect our sales level to go down in a declining market. Next, let's calculate our sales activity variance as it relates to revenue. And again, it's simply the difference between our master budget and our flexible budget. $200,000. Our direct material variance, activity variance is $44,000, $20,000 for direct labor, $12,000 for variable manufacturing overhead, $18,000 for variable selling, and we've got a $106,000 sales activity variance for our contribution margin. Notice there's no activity variance for fixed costs because they remain constant. And in terms of evaluating our variances, our sales activity variance is unfavorable because any decrease in the level of sales will decrease revenues, which will decrease our net income. And again, anything that decreases net income is an unfavorable variance. On the other hand, all of our activity variances for variable cost will be favorable because we did less. We sold and produced fewer units than we would have expected, which results in lower cost, which we interpret as a favorable variance. Again, be careful with that. Had we done nothing, these would have been favorable variances, but overall, not a good thing for the company. Our total variance is the difference between the $200,000 unfavorable sales activity variance minus the favorable variances for our variable cost, and it's $94,000. And that variance is favorable. Make that unfavorable because our net income is $94,000 less than expected. So we've begun to explore the reason our $114,000 actual net income was less than our $190,000 budgeted net income. $94,000 of that was due to a lower level of activity. The remaining part of our variance, the difference between the $84,000 and the $14,000, recall, these will be referred to or calculated as a spending variance. Why did we spend more than we would have expected given $80,000 in sales? So let's begin that process. First, let's look at our sales price variance. Our sales price variance or sales revenue variance is $40,000. We would have expected to have $800,000 in revenues. We ended up with $840,000 in revenues. Of course, we would say that's a favorable condition, and we can see that's arising from a difference in our selling price. If we take our $840,000 in actual revenues and divide it by 80,000 units, we can see that our actual selling price was $10.50 per unit, where we originally had budgeted a $10 per unit selling price. That gives rise to the $40,000 favorable sales price variance. All right, let's move on down. For direct materials, we have a $20,800 variance. And again, these are simply the difference between our actual costs and our flexible budgeted costs. In other words, what did we actually spend when we produced 80,000 and sold 80,000 units? And what would we have expected to spend on 80,000 units? It's an unfavorable variance because we spent more than we would have expected on direct materials. Our direct labor variance is $800,000, and in this case it's a favorable variance because we spent $79,200. We would have expected to spend $80,000. We spent less than expected. The variable manufacturing overhead variance is unfavorable. The variable selling variance is favorable by $4,000. Our fixed manufacturing variance, $45,000, and we would say that it is favorable, again, because we spent less than we would have expected. The fixed selling budget is favorable as well. And then, of course, we can total up our columns. Our total manufacturing variance is 21,180. When we calculate that amount, be sure to take into account that some of our variances are favorable, the 800 and the 4,500, while others are unfavorable. And overall, that variance was unfavorable. The selling general administrative variance was 11,680 favorable, and of course the sales price variance was $40,000 in favorable variance. And if we combine the 40,000 favorable and the 11,000 favorable, that's 51,000 something, and we subtract the unfavorable variance, we get the $30,000 total spending variance. In our variance report, we break these out into separate columns. We could have combined them into a single column just as well. The next exercise we consider will evaluate these $20,800 direct material variance, our direct labor variance, and our variable manufacturing overhead variance. We will break these down into price and quantity variances. Recall our gasoline example. We had a $9 favorable spending variance. We were expected to spend $72 on gasoline if we drove 900 miles. We actually spent $63. We spent $9 less than expected. Why? And we broke that $9 down into a price and a quantity variance. We will break down this $20,800 unfavorable direct material variance into a price and quantity variance. We will break our labor variance down into a price and quantity variance, typically not called price and quantity, but rather referred to as efficiency and rate. And the same thing with our variable manufacturing overhead. And we will also isolate and break down our fixed manufacturing overhead variance.